As macro conditions shift, emerging market bonds are coming back into focus for some yield seekers due to their lower duration, higher yield, and prospects of diversification when compared with those of developed markets. Launched in 2024, the iBoxx USD Emerging Markets Broad Overall Indices represents the most comprehensive fixed income hard currency snapshot of the market due to its broad methodology construction. And with that as the backdrop, hello everyone, I'm Michelle Yu. Welcome to Asset TV, and joining me right now to discuss these new tools are Anu Ganti, U.S. Head of Index Investment Strategy at S&P Dow Jones Indices, and Mandy Zhu, Head of Derivatives Market Intelligence at Cboe. Thank you so much for both being here. And my first question is, what does S&P DJI's research have to say about why indexing works in fixed income? Anu, I'm going to have you take that one.
Sure, it's a great question, and indexing in fixed income came later. But what we found in our research is that the growth rate of indexing in fixed income has actually outpaced that of equities over the past 10 years, which has been pretty fascinating. And if you look at fixed income indices, they're very unique because they tend to be a lot broader, a lot less concentrated. So a degree of sampling is pretty common. And what we found is that while benchmark replication can be harder than in equities, technology advances have made it possible to now replicate a fixed income index and to do so net of trading costs. Another interesting trend within the fixed income space is just potential sources of alpha, if you think about it. So retail investors, for example, their ownership of individual bonds has been low and declining for decades. And there's many reasons for this, because bonds tend to be more expensive, there's more maintenance involved, bonds go through upgrades and downgrades and mature and default, so it tends to be more work. On the other side, you have central banks as another potential source of alpha, who may be purchasing bonds for policy purposes. But despite these two potential sources of alpha, the gain hasn't always been easy for active investors. And we know this from producing our SPIVA scorecards, which stand for S&P Indices versus Active. And now we're able to report on fixed income underperformance rates thanks to the availability of fixed income indices. And to give you a couple of stats, over a 15-year period, we found that more than 90% of active emerging market debt funds underperformed the benchmark. Very similar results in high yield, investment grade, the government space. So that's been an interesting finding that we've seen, which really shows the benefits of an index-based approach.
And Mandy, how have U.S. interest rate changes impacted the potential opportunities set in emerging markets?
Great, that's a great question. So I would say obviously US dollar rates have always been a main driver of emerging market bonds. But what's really interesting about this cycle is that a lot of the EM central banks and countries have been ahead of the curve, ahead of the US in terms of hiking rates more aggressively before the Fed started hiking, and now cutting rates already before the Fed has started to cut rates. And as a result, if you look at emerging market sovereign bonds, they actually performed very nicely last year, despite obviously US bonds, developed market bonds struggling quite a bit. I think this year it's going to be a little bit of a different story as kind of the consensus or the outlook around the US dollar and dollar rates really get more mixed. I think a lot of the returns in emerging market bonds is going to be driven by more idiosyncratic risk factors such as local elections. We obviously have regions such as like China and Asia doing really well versus others, Latin America, where it's been a lot more mixed lately. So I think dispersion of returns and more mixed performances and being very selective about the countries that you're looking at, that's going to be the name of the game for this year.
Well, now I want us to take a walk through the iBoxx USD Emerging Markets Broad Overall Index family and the methodology powering these new benchmarks. Can you take us through that?
Absolutely. So the Broad Overall series gives you a comprehensive overview of the EM hard debt space. It covers sovereign bonds, sub-sovereigns, covered bonds, corporate bonds, and there's a couple of requirements, which are bonds must trade in international markets, have at least $250 million in notional. And one of the unique facets is there's no minimum time to maturity rule. So bonds are allowed to mature in the index, and then the proceeds are subsequently reinvested. So now let's break it down further. We have the Corporates Index, which covers corporates and covered bonds. There's more than 2,000 bonds across more than 800 issuers. And then you have the EM Sovereigns and Sub-Sovereigns Index, which covers more than 900 bonds from more than 100 issuers. Now, this index is important because it serves as the basis for the EM Liquid Sovereigns and Sub-Sovereigns Index, which selects bonds with at least $1 billion in notional and 1 year to maturity. And this index serves an important part of our iBoxx EM tradable ecosystem, which Mandy will speak more to as well.
And well, Mandy, speaking of, how has the fixed income index ecosystem affected the liquidity of bonds historically, and what could these trends mean for emerging markets?
Great. Yeah, no, like Anu mentioned, indexing obviously came to fixed income late, but has grown massively and outpaced the growth in equities. The same can really be said about the growth in the tradable product around these fixed income indices, right? So first we had in the corporate bonds in the US, the development of ETFs and now futures and obviously total return swaps. These are tradable macro products that fixed income investors can gravitate to trade or to hedge their books. And now we're very excited about this kind of bring this development over to the emerging market sovereign bond market with the development of futures around these indices as well that will allow investors more effective tools to hedge their portfolio, to manage cash, reallocate, etc.
Well, here's the thing. How can these indices help market participants understand and analyze the potential opportunities and risks in emerging market hard currency debt?
Yes, and you mentioned at the beginning that EM bonds tend to have lower duration and higher yields compared to developed markets. So that makes it an important case when thinking about diversification within the EM space, diversification across asset classes. Also, EM liquidity conditions are directly impacted by the Fed, by the rate of U.S. rates and their trajectory, as Mandy touched on earlier. And interestingly, we found historically that hard currency EM debt tended to be less volatile than local currency debt just because of less exposure to local interest rate risk. And I think this is a very timely, opportune time to be looking at emerging market debt with all the concerns about inflation globally that we've seen, with uncertainty with central banks and the future trajectory of rates with the Fed all around the world. So an interesting time to be looking at emerging market debt and specifically indexing within this space.
All right. Well, Anu and Mandy, thank you so much. That will wrap up our discussion. Thank you so much for educating us on why indexing works for fixed income. And if you want more information and want the latest research data on S&P DJI's range of fixed income offerings, please visit the link below. And that'll do it for us here at Asset TV. Thank you so much for watching.